Hi, welcome to This Week in Oil. We've got a special report for you this week. I'm excited to bring you this information. I've been working really hard on it. So, in this special report, I want to cover two main things. One, the impact of the potential tariffs on crude oil in the US. And secondly, to walk you through some very basic refinery operations so you have some idea of what actually happens behind the scenes. Hi, I'm Aaron of the Oil Balance with 30 years of experience in trading and oil analytics. I spent a decade on Wall Street, and most recently, I spent another decade as a lead analyst at a major international bank. Stick with me, and I'll help you understand the oil markets. But let's get right to it. I've crunched the numbers and I've done the math, and I've got some really interesting results I want to share with you. By taking the most recent monthly data from the IEA in all of its glorious detail, we can really break down and figure out where barrels went, how they were consumed, what was the price, and extrapolate that information into what might happen in March when and if those tariffs go into place. Again, we're going to be mostly focusing on the Midwest and the Gulf Coast. These two regions together add up to about 79%, 78% of the total refining capacity in the United States. So it's a huge swath of refining capacity, and they'd be directly impacted by these tariffs. It's also home to the futures delivery location on the NYMEX, that's Cushing, Oklahoma. All right, well, let's get right into it. Just give me 1 second here. I do have a special presentation I made for this. If you want to get yourself a copy of this slide deck, please hit me up on theoilbalance.com and I'll put the same website in the details below. And you can get it there. But we're going to go through it right here, and I'm going to sort of explain to you what it is I'm trying to convey. All right. So let me slip over here to the charts. There we go. So first of all, like I said, I want to go over with you some very basics of oil operations, of refining operations. So as you probably know, crude quality can vary quite a bit. The stuff that we're getting from Canada right now, again, is this really heavy stuff. So we look at crude oil by API is one major indicator that people might look at, traders might look at as API. That's a similar way of saying density. There's a very easy calculation to go back and forth between specific gravity and API. It's the same idea. The higher the API number, the lighter the crude, the lower the API number, the heavier the crude, and then water is about a 10 API, just for your reference. But what I want to point out here is I've gone through a bunch of assays. Again, this is all publicly available stuff that we're going to go through on here today. I've gone through a bunch of assays that you can find on the internet and then grouped together some of the results for you. So I've put them into three basic slots: gas and naphthas, the middle distillates, kerosene and gas oil, and the atmospheric residue. So this gas and naphtha is not necessarily gasoline. That may be what you think of when you see that gas. That's not really what I mean. What I mean is the light ends. So your ethane, your propane, your butane, etc., plus your naphtha, your C5, and from there. So if you want to think about it this way, yes, the gas and naphtha do go a long ways towards making gasoline. These middle distillates, kero and gas oil, that's going to be your jet fuel and your diesel cuts. Then the atmospheric residue is kind of what's left over at the bottom of the atmospheric tower. That's put into various upgrading units. You can have a vacuum crude unit. You can go into a coker. From there, you can go into units that upgrade the coker gas oils and whatnot coming out of there into an FCC to make gasoline, into a hydrocracker to make more diesel fuel. So, sort of because our refinery complex is so complex, especially in Pad 2 and Pad 3, the Midwest and the Gulf Coast, we're really set up to take these really heavy percentages of atmospheric residue because we have all those upgrading units I just mentioned. And so we can sort of squeeze out a lot more diesel and gasoline than just what a simple refinery could. So I really want to make crystal clear to you that 40, 42, somewhere around in there is kind of what WTI has been coming in at. This would be sort of your shale crude. Your lighter shale crudes would be up here around a 49 API. So again, you get a decent amount or a large amount of these gases and naphthas coming off of there, but you get a relatively small amount of the atmospheric residue. And on WTI itself, you're probably looking at closer to 30% atmospheric residue, but these are just some numbers I was able to come up with um, off of things that are sort of publicly available. I don't want to be giving out any subscription details on here. But again, just to look at the charts, this is a chart of the same number set as the API increases. So as the crude is lighter, typically we get fewer and fewer volumetric yield of the atmospheric residue. As you go over this way to the right on the API chart and things get heavier, you've got a lot more atmospheric residue. Opposite on the gas and naphtha, where that middle distillate cut stays about in the middle, in the center range, with about a 10% volumetric yield difference among them. So that's relatively consistent. The other thing I want to talk about real quick is tower flooding. So if you think about how to refine crude oil, what you're doing is you're taking the crude oil, which is just like a big soup of different hydrocarbon chains, right? And all these hydrocarbon chains have different boiling points. So you can kind of think of it a little bit like steam. If you want to, let me bring this back real quick. You can kind of think of it as steam. If you're boiling water on the stove and you get the steam coming off, and then you can collect it on a cookie sheet or something. If you have that set way above your burner, you can do a little experiment and watch it condense. If it's high enough above the pot, it'll condense on that cookie sheet and start to run off. Same idea, except instead of having one sort of molecule that we have in water, crude oil has a ton of different molecules in it, right? Of different lengths of hydrocarbon chains. So they're all going to have different boiling points. So in a normal operation, let me get the old laser pointer going here. In normal refinery operations, you'd heat the crude oil up to about 700 degrees or so, and this is just sort of meant to be the very top of the atmospheric tower. Anyway, the vapor, the basically the steam of the crude oil, if you will, floats up through all these different holes in these trays, so that you can think of these trays again like a cookie sheet, but with a bunch of holes in it to let the vapor pass through. And the idea is to capture the liquid as it condenses as you go farther and farther up. And these towers are massively tall, right? So on the left side here, we're looking at sort of what a normal operation would be. I broke out the crayons for you guys, trying to make this as clear as possible. So imagine this is a tray. This is your top tray up here. It's probably capturing your ethanes or so, your really light molecules. And when everything's going right, that kind of spills down to the next tray. Now you're picking up your propanes, and then on to the next tray, you're picking up your butanes. From there, they have a side draw. So they're able to take this combination of the very top cut of the crude oil and take it to another unit which is capable of handling these specific molecules in this specific mixture. As we continue to go on down, you can see I changed the color to blue. This would be getting into your naphthas, your more gasoline, things you want to blend into your gasoline eventually. And so it's turned a different color because they're different length of molecules. And now instead of being yellows and greens, we've gone more towards the blue, and so on and so on. That would continue all the way down, as I mentioned before. So you'd have your naphthas, and then you'd have your kerosenes, and then you'd have your distillates, and then the atmospheric residue. So engineers spend a lot of time figuring out exactly where these trays need to go within the distillation column, within the atmospheric distillation column, and exactly where these side flows need to go. Now you'll see some of this vapor just will continue on up. There's this whole system that I didn't include here that would bring this back around as a reflux and run some of those vapors again and see if you can't get them to condense out, and just try to squeeze out as much as you can from this. So this is the ideal state. Now imagine if you had way too many of the light ends. So imagine for a second if you went from processing something like this guy down here, the 23 API, with only 8% gasoline and naphthas, and then going to like a 42 API, sort of like a WTI, sort of similar crude, and now you've gone to 36% yield of gas and naphthas. Okay, you're going to completely overwhelm what the engineers set up to do. And that's what I'm trying to illustrate here. So the vapor is a thicker, I try to use a thicker crayon, if you will, to show there's more vapor coming up. You see already you're actually spilling over the top of the trays because you're collecting more liquid than what the trays are meant to capture. Again, in this situation, everything's working fine. Excuse me, and you're capturing as much of the product as you want to on the trays. Over here, you get into this flooding situation where now you're starting to overflow. It's bad here in the very top. It gets much worse when you start going down into these blue cuts, if you will. I kind of tried to set them up similar. You can see a lot more yellow has come into where it should be blue and has turned this odd green color. What I'm trying to convey there is you're mixing the wrong hydrocarbons. For this naphtha cut that would come next off of the side draw, you're getting things that the equipment is not expecting to see. You're getting a lot of the lighter ends that have spilled over, that have flooded over the trays where they're supposed to be, and now your fuel it's off spec. It's not what you expect it to be. You could have some very serious operational problems as you try to continue to work with this sort of now contaminated or unexpected product in these draws that you thought you were getting. So it is a really big deal. And hopefully I illustrated that well so you can kind of see what's going on. If we get back into the charts here, let's go back to sort of the task at hand and talk about really quick where we are in terms of the potential tariffs. And you'll see why I did that little detour there at the very beginning. So if you look at the November numbers, again, which is the most recent monthly data we have, it goes into a ton of detail. Just over half the crude run in the Midwest, or PAD 2, was from Canada. I think it was 50.7%. If you look at the Gulf Coast, or PAD 3, that comes down, the total imported barrels that were actually consumed comes down to only 15.5%. Of that 15.5%, 65%, so the majority of that Gulf Coast crude that was run in refineries came from Canada, Mexico, and Venezuela together as one big group. So yeah, these tariffs are a very big potential deal in terms of what we're trying to import. In the Midwest, we could have some huge implications from this. In the Gulf Coast, I think there's some workarounds, but that's kind of the point of this chart pack, is to go through it and lay those out for you so you can kind of have some sort of understanding of what's coming. Again, as far as I know, there's going to be 10% tariff on Canadian crude starting in March. I've seen some back and forth on whether or not the Canadians have met Trump's demands, whether they're going to do that or not. So it could be the case all of this concern about the tariffs just kind of goes away, but I want to cover it anyway because I think it's a really good teaching moment for everyone out there. So stick with me. We're going to get to some really interesting data here in a minute. Again, as far as I know, 25% tariffs on Mexican crude starting in March, and then a total ban on Venezuelan crude, which again, it's a decent amount of crude coming into the country. I think it's replaceable to kind of cut to the chase. The problem is the average API of the crude of these 65% crude was 21.3. So again, thinking back to that table I had a minute ago, it's very heavy. Similar sorts of numbers for PAD 2. It's very heavy. We've got to figure out how to replace that. So I came up with 4 basic scenarios of sort of what to look for. 1, what if we just pay the tariff and pass it on to the consumer? What does that look like? What if we replace the imported volumes with domestic shale? If everything we just been through, you probably know how that's going to turn out. What if we just run at a lower rate, right? What if we just say we're not going to pay those tariffs, especially in PAD 2, we're not going to pay those tariffs. We'll just run what we have. What does that look like? And then fourth, what if we try to find replacements? What if we try to optimize our refining system? How does that look? And what's the outcome of that? All right, so let's get into this here in more detail. So in the Midwest, replacing barrels of shale or replacing the Canadian barrels with shale, what I'm calling topping off, results in tower flooding, and you end up starving the bottom end. So again, think about the table I showed you at the beginning. Here's what I've come up with in terms of, again, using the template of the November numbers as something to go off of, as something to start with. If we just topped off with shale crude, again, I used a 42 API type crude, we'd be making 200 plus thousand barrels per day too much naphtha, another 200 plus of the sort of medium naphtha, and even a little bit extra of this heavy naphtha. But then if you look here on the, this is great, we're making more caro, that's fine. Everything's good there. These three are an issue in terms of tower flooding. On the heavier end of things, the gas oil, so these two end up going into diesel fuel primarily, can move some into gasoline through a cat cracker. But this atmospheric residue, you've got to try to make up 600,000 barrels per day of atmospheric residue to make all your upgraders work. That's not going to fly. That's just not going to work. You're going to hit tower flooding issues, and that's not going to work, meaning all of these other cuts are going to be contaminated. You're not going to have the fuel that you thought you had. There could be all sorts of issues within the refinery itself trying to process this, contaminated, tower flooded product trying to come off of there. Okay, so what if we just do a shortfall? What if we just say we're taking our ball, we're going home, we're just going to run the crude that we already have, we're not going to try to replace anything. So we're sort of cutting out the Canadian crude altogether, we're not going to pay your tariffs. Then what happens? Well, so then you've got massive shortfalls on everything. It's going to be fairly bad on the gasoline side, not too dramatic. We're going to have a big loss on the kerosene, on the jet fuel, and on the distillates. And then we're going to have a huge loss on the atmospheric residue. Again, if you think back to that original table in this report, you're going from something like 60% on a Canadian heavy down to 30% on a U.S. shale type barrel. So you're literally missing out half of your atmospheric residue. So that's going to be a huge issue. Well, what if we try to optimize? The problem is in pad 2, in the Midwest, there's some really big issues, right? So one is there's no way, I shouldn't say that. The way things stand today, there's no serious way of bringing meaningful volumes of crude oil from the U.S. Gulf Coast that were imported. We call them waterborne barrels coming from the Persian Gulf or someplace else that we could import into the Gulf Coast and then move up into the Midwest. There's no way to do that right now. So when I started out in the industry in the 90s, that was actually really common. There's about 1.4 million barrels per day of capacity back then to move barrels from the Gulf Coast into Pad 2, primarily, again, imported barrels. Like if you look at Loop and the associated systems with that, the original Seaway pipeline was, again, going from south to north into the Mid-Con. We've sort of rearranged all that over the past 30 years as we've seen, one, the increase in shale, and then two, the increase in Canadian production, right? So we've sort of optimized our system, if you will, to maximize as much Canadian barrels as we can into our system, especially in the Midwest, and kind of doing away with any sort of waterborne import. So long term, I think that's, it's a fantastic idea. When we're faced all of a sudden with tariffs and you have to make decisions what to do, having some options would be nice. So the point is, at this point in time, we don't have options to bring barrels into Pad 2. I mentioned the Seaway pipeline, the original Seaway pipeline. They did reverse that, as I mentioned, to go north to south. From what I understand, when they made that change, they did add the flexibility to be able to flip that pipe around very easily, to be able to go again from the south to the north. But you're talking like 450,000 barrels per day. So it's not a huge amount. That I did include that in the optimized case for the Midwest. I said, well, let's go ahead and flip that around. and see what happens with the math. So that's kind of a big aside, but just know that that's one of the huge challenges with trying to supply the Midwest with heavy crude, and you're going, for whatever reason you don't have Canadian barrels coming in. It's a huge problem. So let's move on here. Go back to the chart pack real quick. There we go. So as you can kind of see in a side-by-side comparison, the baseline is this dark blue of what we did in November. And again, I've simulated that with crude oil assays, and looking at the yields and that sort of thing from the IEA. So we get basically tower flooding if we try to top off with domestic shale. And then everything else, you've got a lot less of this atmospheric residue, so you're really handicapped on how much gasoline and diesel you can sort of additionally make from what we call sort of straight run products coming right off the refinery tower. The other thing I wanted to mention really quick while we're at it, let me flip back to the screen here. In November, Canada exported 4.6 million barrels per day. I'm rounding up a little bit, 4.6 million barrels per day of their heavy crude into the US total, not just the Midwest, but total. Now, if you go back and use the numbers that they gave us again as sort of a landed price for crude, I don't remember off the top of my head, but it's somewhere in the $62, $65 per barrel range for those Canadian barrels landed in the US. If you do the math, multiply that through, you're talking about $300 million per day of revenue, just from those imports, being able to sell those barrels into the U.S. And over 30 days, you're talking about $9 billion in revenue. So the scenario that I've suggested here, it is a bit of a straw man. It would be catastrophic for both the U.S. and Canada to shut off those Canadian flows. But I still want to go through the steps. I still want to go through these numbers with you and show you exactly why. It might be intuitive, but I think it's also good to have some numbers to sort of back that up. All right, in the Gulf Coast, similar sort of thing. If you try to top off, you still get a flooding issue. It's not quite as bad. And again, the baseline assumption is that we're already maxed out at how much shale we can run. That's sort of an underlying assumption I probably should have mentioned earlier. And you still get a pretty decent shortfall of the atmospheric residue if you just try to top off the missing barrels and just try to run everything domestic with a little bit of imports that aren't coming from Mexico, Venezuela, and Canada in the Gulf Coast. If we weren't to do anything, just run what we have, we can do without those imported barrels. You get a massive shortfall of atmospheric residue. Again, you're looking close to 600,000 barrels per day, and this market's already very tight. I brought this up before on previous podcasts. Gulf Coast residual fuel is below the 5-year range already as far as inventories, and this would just put a massive squeeze on that. So again, probably not the best idea to go that way, but we can optimize, right? We can try to ask our friends and our neighbors that do produce heavy crude to try to play ball with us. Again, you'd probably look at the Persian Gulf as the place to go. Saudi, Iraq, Kuwait, those sorts of countries. So I'm sort of assuming in this case that you're able to talk them into increasing production in the Middle East and to send that over. So keep that in the back of your head too. We'll go through that in a minute. But you do, that's probably the best scenario if you had to not, if you decide not to pay tariffs. That's probably the best scenario in the Gulf Coast, is to try to find barrels from the Persian Gulf. But again, it's not exactly a one-for-one replacement. You're going to have problems making diesel fuel, which again, I guess the good news is diesel fuel, we're exporting 1 million to 1.5 million barrels per day. So there's room to sort of decrease the amount of exports and still keep the US system going if you want to think of it that way. But that's just thinking about the Gulf Coast in isolation. We would also have to think about what's going on in the Midwest. So again, let's keep going forward here. So just looking at the tariff scenario, this is sort of the punchline I think a lot of you were hoping to get when viewing this video. So again, based on the November numbers, if we were to just add for pad 2 a 10% increase on the Canadian barrels, and again that's 50% of roughly 50% of the crude consumed, at least in the month of November, but that again that's a pretty consistent result that's not unique to November. Then you're talking about a $3 and change increase per barrel with the tariffs. In terms of dollars per gallon, you're talking about 8 cents per gallon. So that might not even be something that you would notice, again, assuming that gets passed on to the customer at the pump. 8 cents per gallon is probably manageable for most people. And especially as I walk you through these other scenarios, you can see why that might be the easiest pill to swallow. And obviously, best case scenario is the tariffs never go into place and never go in place in the first place, and you don't have to worry about it. But I like walking through these numbers just to see what would happen. On the optimized, again, we're looking at 450,000 barrels of Persian Gulf heavy sour coming into pad 2. We're assuming that Seaway gets reversed and you're able to actually do that. We're also assuming that we're able to talk our Middle East friends into increasing production, which is not easier said than done, perhaps, but that's kind of what goes into the math behind the scenes here. In pad 3, it's a little dicier, right? So the imports weren't as big of a headwind as they are in pad 2. So again, in pad 2, you're talking about 50%. In pad 3, closer to 15%. The problem is with Mexico, you're talking about a 25% tariff on similarly priced crude. So you're, sort of mid to low 60s is what that Mexican crude is going for. And again, it's a really heavy sour barrel. So the 25% tariff really starts to add up. At that point, you also have to replace the Venezuelan barrels, which again, I assumed you could get that from the Persian Gulf. Again, you have to talk those guys into increasing production. At any rate, if we just go with the tariffs and replace the barrels from Venezuela with the Persian Gulf barrel, you're looking at a change of about $1.18 per gallon, just based on the tariffs. $1.18 per barrel and 3 cents per gallon, which again would likely be passed on to the consumer. That's probably doable. With the optimized scenario, again, you're not running quite as much crude. So that's the sort of the difficulty in running it this way. You're not running as much crude, and you are probably having, at least in the Gulf Coast, there's going to be some shortfalls. I think you can make that up primarily through not exporting. But then what do those countries do, right? They're going to have to price to export as well. The optimized number in pad 2 is a little less reliable because I think in these scenarios you're going to have to price for demand to be cut. So the numbers themselves, assuming all the crude was available, works out to 11 cents per gallon. But at the end of the day, in reality, you're probably pricing to cut off demand. All right, so what do I mean by that? So let's go through this. This is, again, the shortfall scenario. So we're assuming that, we're not going to run any Canadian crude in pad 2, which was 50% of the crude that we ran in November. We're just going to run what we have, and we're not going to add any more. We're not going to add any more U.S. shale. We're just going to, do without. Well, you're looking at a situation where even after you maximize all these intra-pad movements, right? So you're moving barrels from pad 1, from pad 3, and from pad 4 into the Midwest. Again, assuming you can do that, there's just not the pipeline capacity to make up for a 50% cut in crude runs in pad 2, if that makes sense. So this shortfall uh, number, uh, total number, even after your movements from other regions within the United States, you're still trying to make up 1 million barrels per day of refined product, which means you're going to have to price 26% or so of demand out of the market. That's unsustainable, right? So that means all sorts of businesses closing. Construction is hit. Trucking would get absolutely clobbered. Farmers would have a very tough time. I meant to look up what the diesel weighting of grains is, what the contribution is to the price of grains, but that would be sort of catastrophic, right? So this scenario is just a no-go either. So we're a no-go on trying to just replace the Canadian crude with domestic shale, and we're a no-go on just trying to do without. Let's look what happens in the Gulf Coast here, or sorry, the optimized scenario. So the optimized scenario in the Midwest, again, we're looking at pretty severe losses. We're trying to figure out how to we're missing supply for 588,000 barrels per day of refined product, which is about 15% of those total November numbers. That's got to have to price out. Again, that's not a good solution. That's catastrophic. Businesses are going bankrupt. Farmers can't plant things in the field. It's a huge issue. Okay, so and to be clear, like we don't really think that, so there's a non-zero probability of this happening, but it's pretty close to zero, right? But again, just to walk through the numbers and see what the math is like. So the conclusion, the point at the end of all this, if we are going to be tariffed, if those tariffs do go into effect, the way I illustrated them before, so 10% on Canadian barrels, 25% on Mexico, and then just go cold turkey on Venezuelan, that's still your best bet. Yes, you will see a bit of a price impact from it, but the other scenarios I walked you through, especially in pad 2, are just absolutely catastrophic and can't really be seriously contemplated. As we mentioned, trying to replace everything with domestic shale. So if you think about it, like drill baby drill is what you hear in all the headlines, is the thing coming out of the politicians' mouths right now. It's really not going to help us in terms of shale, right? We're sort of at that inflection point where we've taken as much shale as we can in the U.S. refining system. To process any more would result in tower flooding and other issues like that. So basically, the marginal barrel of shale is just getting exported at this point. However, drill baby drill in the Gulf of America now, that would actually be a big deal. The problem is the go time. So once you made the FID decision on shale, you're looking at about 3 to 6 months from FID to actually getting oil into the pipelines going commercial. It's not very long at all, especially if the producer already owns the property or has a lease on the property, and there's takeaway systems in place. There's a good network of pipelines right around them or whatever to be able to get to market. It's very quick, 3 to 6 months. In deep water, not just in the Gulf, but anywhere in deep water, it takes much longer. You're looking at probably 2 to 3 years. And again, it depends on what sort of infrastructure is nearby. At the bottom of the ocean, can you tie into a pipeline system that already exists? Do you have to run a pipeline system? Do you have to create a new pipeline system to get back on shore? Or how are you going to handle that situation? How do you get the crude oil from the middle of the ocean back to where it can be processed? So so that's a big deal too. So let's drill baby drill. Let's drill in the Gulf of America, and that'll help us some. But just remember, that's not a quick fix. That's going to take us 2 to 3 years before we start to see that oil. Again, just running at reduced rates, you would absolutely kill people off. Not literally, but businesses would go bankrupt. Farmers would have a very hard time in the Midwest, where you're actually having to price 25% of the demand out of the market. that's catastrophic. Finding replacement crudes, again, it's possible in the Gulf Coast. There's going to be a little bit of probably a couple dollars more than what I showed, just by getting the Persian Gulf producers to increase production and getting those barrels to market. But again, there's not a good pipeline system. There's not a good way to get increased waterborne crude flows into the Midwest, right? There's just even reversing Seaway Pipeline, which is 450,000 barrels per day, is not going to cover, the 2 million barrels per day or so that we would are at risk, I guess you could say it, with the Canadian crude. And then one last chart here. I keep saying pad 2, pad 3. Here's the map that the EIA uses. So just as point of reference for you. So I hope you found this useful. Again, I tried to go through and explain everything. If you want to get this chart pack yourself, please contact me at theoilbalance.com and I'll send you a free copy of the chart pack. And I'll also have that link below in the description here, but it's theoilbalance.com. All right, take care and have a good day. Bye.